G'day everyone, welcome back to Risk Biscuits. I'm Michael, your host. Thanks again for joining in. As always, obviously to support the show, if you could please like, subscribe, follow on whatever platform you're using, whether it's YouTube, Spotify, Apple, whatever else we're on these days. Your support for the show is greatly appreciated. Today I've got a very, very special guest. Many of you will know him from Twitter. Sal Rubino. G'day, mate. How are you?
I'm great. How are you?
I'm good, thank you. Now, did I pronounce your last name correctly?
Yep. Yep.
Okay, good. I've been practicing. So
Oh,
thanks
okay.
for,
Well, there's a few Italians in Australia, so you might have had some practice already.
yeah, it's not that
Yeah.
hard.
No, it's not. It's not. No.
All right. Just before we kind of get into the meat of everything, I'll just put a little disclaimer up. Look, obviously, Sal's agreed to come on the show today. The show is really for entertainment purposes. It's general in nature. We're not providing any sort of financial advice or any personal advice. Sal's just here out of the goodness of his heart. If you're looking for personal financial advice, please go somewhere else for it. If you're looking just to listen to a couple of guys have a chat about markets and tell some stories, then you're probably in the right place. All right, so let's get into it. So, Sal, I obviously have interacted with you on Twitter. I
Yes, we
know,
have.
yeah,
Yeah.
in the kind of various accounts I've had over the years. But anyway, um, so just a little bit of background about yourself from what I know, and please correct me if I'm off track at
Hmm.
all. Um, you're a vol guy,
Yep.
you know, if that's a thing. You come
Definitely.
from
Yeah.
a yeah, you come from a math background.
A
I
light
think
math background. Yeah. You said, oh, I don't actually have ever taught math, but I was a
okay,
math student at MIT. Yeah. Which I
all
don't
right.
think in itself is terribly important, but okay.
No, okay,
Yeah.
all right. I thought you
Yeah.
taught for
Yeah.
a little while, but anyway.
Oh, I no, I do. I actually teach high school math a couple days, afternoons a week for a couple
Oh,
hours, a
cool.
couple afternoons a week. And I do it now. But that's something is I don't know, something to for variety and to I'm hoping that when I'm older and in a care home, one of these kids remembers me.
Yeah,
You're,
fair enough.
all right. So other than that, yeah, I mean, my education was very good and I was very lucky, but I didn't set any records for either diligence or insight. I have to say. So, but the main virtue of that was that it got me a look at some good places to work, and I ended up at SG SocGen
Okay.
after I graduated. So that's where I started. Yeah, in the
Yeah,
options
so
department.
maybe let's go back to the beginning. So, you're at MIT, you're studying,
Yeah.
obviously, presumably you're kind of looking for a role out of school. So how did that kind of all evolve, and was trading
Yeah.
always on the radar, or was it just sort of something that you fell into?
No, it was never on the radar. In fact, my senior year, I had always thought I'm going to go to graduate school. I'm going to be, I started out thinking I was going to be a physicist. And then for a while, I thought I was going to be an electrical engineer. And
Okay.
then I really became a coward and decided I was going to be a mathematician. And the reason for that was my abhorrence of lab work and having to actually do anything with my hands. So but then I decided I don't want to go to grad school. I'm not, there's a lot of people who'd be better with that than I am. And it's not for me. So I ended up talking to the career office, and they said, well, there's a place called Wall Street, and they hire people to do stuff with numbers now. And, this is 1988, and the IBM PC was used in 80 or 81, right? So this stuff is pretty new. And I said, okay, so what do you do? And they said, well, they have investment banking and they have trading. And, I didn't really understand the difference. But after a few interviews, I kind of figured out that investment banking requires a lot of soft skills, a lot of polish. It's it's at the list of 10 things I'm good at, I'm not going to put those in the top five.
Okay.
So I ended up in trading and I liked it. And I thought, oh, options are really interesting. I decided, oh, options, these sound really interesting. And it was the second semester of my senior year. and I took a class in the business school, options. This guy John Cox taught it, who wrote a book about options, and it was a dull class, but it was an interesting subject matter, and so that's how I got interested in it. And then international financial markets. There's essentially, in trading, there was investment banking, which is stock trading, which for some reason I've never had much interest in.
Okay.
And there was, I don't know. I mean, I saw Wall Street, I guess. It influenced me in a negative way. I thought, oh, I don't know if I would like that sort of atmosphere. But I had I thought international financial markets interesting. And they said, well, in international financial markets, there's two things. There's foreign exchange and there's money markets.
Yep.
And money markets was, overnight repo, deposits, FRAs, not that interesting. And foreign exchange was, international finance. And I saw, these sort of couple clips. And I thought, oh, what an interesting business. I think I'm going to try that out. So options on foreign exchange. That's what I
Okay.
want to do. So, so I um, ended up in Philadelphia that December, and SG started. SG had a New York office, and at that time, for those of you who speak French, and I don't, there's a movie about the rise and fall of SocGen's auctions department, and it was created by a guy, Antoine Pie, who was my boss's boss in the 80s, and he thought that the next front of financial innovation was in the options business. And
Okay.
he was one of the very early pioneers in options trading. And he started this options department, and they started trading options on all sorts of things. They started them at TIF, French equity options. And they ended up in foreign exchange options. And in the early days of foreign exchange in the 1980s, early 90s, they were probably one of the big five FX options houses in the world. Them, Banque de Suez, First National Bank of Chicago, J. Aaron, and which was Goldman Sachs, essentially their commodities arm, and I don't know who the fifth one is. I couldn't tell you. Anyway, I ended up on the Philadelphia Stock Exchange, and the Philadelphia Stock Exchange was is a venue. It's part of NASDAQ now, and it was a physical stock exchange as opposed to a commodities exchange. So it followed the equity system, which is a little bit different than the commodity system. And the options were traded on the PHLX, were G10 options against the dollar for fixed expirations and fixed strikes. But they were options on cash, American style.
Okay. Yep.
And they were very popular. And, they started I think in 82. By the time I got, in the late 80s, they probably peaked at about $6 billion a day of volume. So that's not huge by today's standards, but by then it was a pretty substantial portion of the market. And it was a market that was open standard hours, more or less, early morning until say 2:30. I think it was 7:20 to 2:30 in the afternoon. And then they opened a night session for Tokyo, and that was very successful, where Salomon Brothers, investment bank out of Tokyo, their Tokyo arm was very involved in that at the time. And then they added more hours and, started covering and, started opening at the London Open, and then stayed open until the afternoon. And then, so they were open most of the day then. And so it was an interesting place to work. And it was an interesting place to work. It was an interesting place to learn. The original partners of Susquehanna were on the floor then. There was a company called Cooper Neff, who I always rated as the smartest people on the floor. And Cooper Neff was an options market maker. Then there was O'Connor, and O'Connor was a big options market maker out of Chicago, and very numerate, very intelligent group of people. So there was a very good experience, and the French dudes were very, very good, very, very mathematical. We all slag off the French quant, but French quants are pretty good, and French options traders are actually, I rate them very highly. I rate the French options derivatives trading community extremely highly, even though in the Anglosphere we like to slag them off a lot, probably because it's fun, you know. But so it was an interesting time, you know, too, because I got there and, you know, I was only working a few months and the whole thing in Tiananmen Square kicked off and dollar yen went absolutely ballistic, you know, and there wasn't really a market in CNY or CNH then. Okay. So it was all dollar yen and all hell broke loose. And it was just fascinating watching what was going on. Tiananmen happened, and then October, I think, the Berlin Well fell, right? In October '89. And then, you know, a few months later, you know, there was a German reunification. And then during that time, Iraq invaded Kuwait in August of '90. And that was an extremely interesting time for Eurodollar and for options, FX trading. You saw a lot of enormous amounts of volatility. And, you know, it's sort of, you know, there was invasion. I remember January of '91 invasion, being in the office and watching, you know, kind of moves that we don't see anymore or very infrequently in currencies. The kind of moves that you see, you'd think you'd see them once in a lifetime, but you actually see them once every 10 years. And that's what I'll get to, is you see these moves, you know, predicted by models that are supposed to be, you know, the Six Sigma events that seem to happen every 10 years instead of every, you know, 1,000 years. You know, I learned a lot about mismanagement, like, you know, having open strikes and not open strikes and what to sell. It was all rule of thumb, you know, because we didn't have the technology that we do now. You know, the end of my culmination or whatever, my career was when around the time I left and moved to New York was when Soros, quote, broke the pound. And I remember we're standing on the floor and it's London Open, like on a Monday morning. And someone comes in, nothing's open. You know, there's no OTC market open in London. The brokers are all rolling in. It's like 7:30 in the morning in London time. So we're standing around on the floor and the guy asked for, you know, the sake of argument, he asked for the price of a 1 month Deutschmark straddle, dollar mark straddle. And say the straddle was like 120, 130 in ticks. The guy, you know, the broker takes them at 130. And I look at the guy from CRT, which was a big market maker. He was the first guy. He lost like 200 of them. So he goes, okay, 128, 148 or something like that. He goes, take those two. I'm like, oh boy, this is interesting. And then so the next market comes back and we all feel sorry. We go, all right, 130, 160. And the guy goes, take them. I'm like, shit, you know. And we knew it was up. We found out later it was Bankers Trust London running us over massively. They were the guys who decided. Bankers Trust was very, very good then. And the London operation was extremely good. And they really smoked our ass. It was really funny. But I'll never forget that, you know.
So that Soros trade, like, you know, obviously he and Stanley Druckenmiller get, like, you know, all the sort of fame around that trade. Was that like a well-known trade at the time? Were there other people that were sort of on the same side, or did he just kind of pick that out of nowhere?
It wasn't out of nowhere. Okay, it was not out of nowhere, and I think he initiated it. I think they saw it and were able to pile in size before it got really big. And, you know, I was thinking about this last night because I was reviewing your notes about what we're talking about. And the thing about the Soros Druckenmiller trade was there was a lot of pressure, right? It was the ERM. You know, I think the issue at the time, correct me if I'm wrong, was that the sterling was going to enter the European exchange rate mechanism, but they didn't think it could actually enter at the price that against Deutschmarks that they thought it was going to. That it had to be much lower, even though there was a reunification going on in Germany. So, you know, at the time, you know, during this time and in early September, the Bank of England was intervening. And later on, I left SocGen a couple months in the autumn of 92, and I joined NatWest Markets, which is a British bank, and NatWest became, became RBS, and the infamous basket case in the in 2007. It's renamed NatWest again. But anyway, so NatWest is, quote, one of the clearing banks, one of the banks that were used in gilts auctions by the Bank of England at the time, and saw a lot of them, and also an intervention bank for the Bank of England for the intervention desk. So my understanding was that they were, on the bid on sterling mark, and they were bidding sterling against marks, and they were on the bid for several days, and they were telling people, we're not taking any small tickets. So all day long, they would make a bid below the intervention rate. And then when they get 60, 70 million pounds, hit the button, call Bank of England, and they say, yep. I said, I'm terribly sorry, but I need to give you 70 million pounds at, rate X. Okay, thanks a lot. And this went on for several days until finally it just went oof. And there's a great picture in the Bank of England Museum taking of the desk at the moment where they let it go, and the reaction on everyone's face. So if you're ever in London, it's worth going to the museum and seeing that photograph. It's really interesting.
Yeah,
but
cool.
Yeah, it was interesting. It was very interesting, and you don't see, we don't really see stuff like that so much anymore, but yeah, but anyway, getting back to the history. Yeah, so I had some institutional roles. My career is very, it started, I was on OTC desks in New York. I was head of OTC, FX options desks, so forth. I worked at NatWest twice. I worked at Merrill Lynch for most of the 90s. I worked at CS First Boston, Credit Suisse, in the early 2000s. Citigroup, JP Morgan. I ran a pod at Citigroup's hedge fund, Tribeca, for a while, up until the financial crisis, just before, during, and a volatility pod. And so that's the kind of institutional experience I had. And I spent which for me was a very uninteresting and tedious time working in the risk management department of a very major New York City money center bank. And for some people, it's a great place to work. It's a great company. I just didn't enjoy my experience there. I'm a trader. I'm not a risk management guy. I'm not a guy that likes to write reports.
Okay.
So in 2017, I decided to sort of start reformulating what I did from a smaller scale where I could be my own boss, sort of, or my own operator. And I call myself now a small-time multifamily office guy, where I manage a portfolio of options. I'm an options trader. The options are mostly in foreign exchange. They're G10 primarily. Well, they're all in G10, to be honest with you. And I also do S&Ps and a little bit of VIX. So the S&P VIX complex and the G10 FX complex. And I started doing the S&P complex because since the great financial crisis, my institutional experience has always been in FX options, fixed income, hybrids, exotics, all these sorts of things. So moving along, that business kind of died a death when QE started. I mean, when global rates are pretty much set at the limit to zero, there wasn't much volatility in the foreign exchange market. There wasn't a lot of, now the whole side of FIC, the whole FIC market was screwed up for 10 years. I mean, FIC markets got busy in 2020, and it was the first time since 2013 or 2014 that they're actually worth being in, and 2020 for all unrelated reasons. And 2021 was sort of a continuation of the same phenomenon. But 2022 is really like 2020, I call it the rebirth, or the golden age, the rebirth of the foreign exchange market, foreign exchange volatility, because the last couple of years have been comparable to the 90s in terms of opportunities. So
So what you're doing now, how does that compare to your days when you were like running the volatility pod? Like, are you sort of running very similar strategies or sort of completely different?
well, okay, that's a good question. I am, I'm a, no one pays attention to me anymore because I can't demand them. I don't, produce giant tickets anymore. So, I'm not a giant trader. So no one really, no one's bothered with my interests. So I
Yep.
have to sort of like, deal with things. Other than that, it's pretty similar. I don't do any OTC stuff because I can't. I don't have an ISDA, but all the S&P stuff that I'd be interested in trading, even if I were sitting at the biggest shop in the world, trades on the CBOE and the CME. So that's not a problem for me. And as far
Yep.
as FX, I can find things. I can find, in 3 or 4 core currencies, there's no problem getting liquidity I need. I'm a, if you talk about notionals, I'm a 2 to 700 lot guy on the CME in FX options, and maybe 1,000 lots in the S&P stuff, or in the small S&P, like the ES contract, this futures contracts. I want to be 500 of the big one. So my liquidity isn't a problem. So that's kind of the space I'm in. I have always been a very, very, I think that when you talk about derivatives and profitability, there's 2 ways to make money, at least. One is the issuance and then maintenance of a book of very complicated structured products, and then including second generation exotic options, so on and so forth. Notes, structured notes, and I've been involved in some of those things. And then there's sort of the more vanilla end of trading, where you're looking for dislocations, short-term or medium-term dislocations in surfaces that are, they're caused sometimes by, either macro, top down, or micro, bottom up. And so that's the space I concentrate in. That's the space I'm interested in. It's more of what I've always been interested in, and more, I think we've had this discussion. I don't know if you and I have had this discussion, but the biggest blow-ups before the great financial crisis in derivatives, I don't think they've been structured products so much as just fundamentally wrong views on the underlying expressed through an options position. Where, for example, dollar yen did 20 big figures in 2 days down in 98. When interest rates in the early 90s, we had a big move in interest rates in the 90s. It was probably comparable to what we saw in October. You had a derivative that you either bought or sold to somebody. It just got underwater and it just kept going. Really simple. Okay. What you see in the more recent burn-ups in the markets, real blow-ups, has been structured products that didn't behave the way they were expected to behave because assumptions about how they're structured and what was going to happen didn't obtain. Like correlation X and correlation Y didn't go the way they were supposed to. And there was no ability to hedge the product, or it went very quickly. And, then it went very quickly. There were like window barrier options where, there's a number of cases. I can't get into too many details, but I'm intimately familiar with the window barrier option, which is a very, very large option that was written by a municipality in Central Europe. And the point of this option was to provide them with some income. And the idea was this option, these things always knock out within 3 months. Well, the GFC happened. Correlations to dollar went extremely high. This option went deep in the money, and their mark to market was 850 million euros the wrong way. That's a lot of money for a town in the middle of nowhere, right? Suddenly, the treasurer gets a call. So these things happen, right? So the products, these things have changed, and the source of financial stress, like during the, I guess you could say it was fundamentally bad mortgages that kicked off the financial crisis, but the sort of knock-on effects, these sort of over-exuberant structures, where the 30-year baht yen option, Thai baht against dollar yen option that has like some variable coupon attached to it. That's you're not going to know what it is until 20 years in, kind of thing, which is, these things exist. They still exist. They're on the sort of roll-up desks. and there's going to be guys older than me in a few years still managing these things as they go into the last 15 years of their life cycle, because they were issued when they were 30. It was 15 years ago they were issued when they were 30 years, so they got 50 more years to go.
Yeah,
So it's going to
right.
be interesting. So I keep it simple. I always kept it simple. You know, you say a volatility. You want to say, what's it to be a volatility trader? I mean, to me, being a volatility trader is just being an options trader. And that means that, and all these things are options, whether they're simple or they're very complicated, they're either options or combinations of options. The underlying thought process is the same. And by volatility trader, we mean that to be very nerdily specific. Let's consider the Black-Scholes formula. In the Black-Scholes formula, there's 6 parameters. And the idea is that when we enter in an options trade, we know with certainty 5 of the 6 parameters. The only one that we're interested in, that of the 6 that we're interested in, is the implied volatility. So it's an input into the model that gives us a price in the equity world. In the FX world, we start, everything you do in FX is ass backwards. Okay, that's one thing. You start out in fundamental and equity options. Exchange traded options, generally the first options is price. You observe a price in the market, and then this price corresponds with the date, strike, an underlying an interest rate or interest rate differential, and a dividend stream. And then the mystery parameter is implied volatility, right?
Yep.
So you back solve to get the implied volatility. Yeah, we do that the other way in FX. We're presented with the surface of the volatilities, and we go the other way, and then we say we want to trade the at-the-money straddle. We say, we're going to trade it at 12% implied volatility. Then we go back and forth and set the parameters, and then produce a price that's downstream that gets entered into our book. Now,
okay, yep.
So what I'm interested in is that number. Is it going to go up or is it going to go down? Implied volatility, that's what I'm trading. It's like trading Apple. Is Apple going to go up or Apple going to go down? That number to me is what I'm interested in. Is the implied volatility of the surface, generally speaking, if I buy a 1-month straddle and I pay 8% for it in the S&P, is it going to go to 9% or is it going to go to 7%?
Yep.
Okay. Now, to make it as simple as possible, I'm interested in, I'm an RV trader, okay? And I have sort of a process, a macro process, and sort of a bias is that I look for opportunities. I'm best at trading from long vol and short vol. I'm better at that, okay? And that's different than a lot of people.
Yeah.
But I'm better at it. And what I do is I look for opportunities where I build a position, and I start usually building a position by buying options, buying straddles. I don't know if you have it in Australia. We have these signs in the US, like some attorney, you'll be driving on the road. It says, "I sue drunk drivers." My joke is I buy straddles, so start by buying straddles, and I'll think about, why is it good value? Why is it good value? Is it good value because if I'm initiating a position from scratch, I'm thinking it's cheap. Why is it cheap? Well, it's either trading either below, which is extremely rare, or it's trading very close to recent the rolling actual realized volatility. So renting that position isn't going to cost me that much on a day-to-day basis. Also, I like the date, I like the strike, and it sits in a neighborhood that I feel I can operate in. That is, here are the points on the curve. I'm here, buy this one. I might sell an option a little lower strike closer, might buy another one further out. But I'm looking for different points on the surface to construct a position. So, right. So that's where I'm looking at essentially how I trade. And that's where, and I don't know if it's alpha or it's beta. It's money. I take it. Hopefully there's more of it coming in than going out. But that's the story. And, how do I make that decision? Well, there's a number of ways to do it. I have a number of tools. I look at implied versus historical volatility. I look at, rolling like everyone else does. I look at, rolling realized volatilities. I look at, both even weighted and exponentially weighted moving averages. I'll look at 5 minute, 1 hour, 1 day, and multiple days. And after a while, there's not not a formula that I use to decide when to enter a trade, but it's based on quantitative reasoning. Sometimes I'll enter into a trade because, for example, I'll own September options in September and be short options in April. And the reason I do that is because there's certain mathematical characteristics of these options relative to one another that allow as time passes, that shorter option will, if I'm right, based on my analysis of where volatility is at the moment, where not so much my forecast, but how the curve shape is going to move. The option that is longer dated, for example, or a little bit more out of the money, will roll in value in a way that will preserve its value, and the one I'm short will roll in a way that its value will decrease more quickly. Okay. Yep. And so, and I'm also interested in, characteristics of Greeks, like gamma versus theta, gamma theta ratio. I'm interested in, the famous Vanna Vega, sort of thing. I'm not a tail guy. I'm a tail risk guy. What I am is sort of, I can't predict the future, but I try to manage, manage my outcomes as well as I can. I prepared for the future, and I like to be what's called long the accident. So if something happens, my position moves in such a way that suddenly I'm going to have a good position to trade against. I'm going to have, I'm going to have some long vega, I'm going to have some long gamma, I'm going to be able to trade, or I'm going to have some short gate. And, a lot of times that doesn't depend on the absolute level. It depends on what the shape of the at the money curve is, the shape of the risk reversals, and how they, in the front versus the back. And, it's really, so in interest rates, you call it basis trading, because at the end of the day, when you look at the overnight report, you'll see spot and you'll see a P&L with different changes in spot, right? And it's hard to tell what's behind that number. But usually what happens is that with me is that if it sits in a range for a while, I either make or lose a little bit of money, but I'm more interested in bigger moves, and then the position becomes a lot more interesting. Yeah. And there's ways to do things like simulate risk reversals with longer dated versus short dated, closer to at the money options. So it's kind of a very, I don't know, it's very technical. It's not something that you do from, it's not really an investor thing. It's a strategy, and it's a strategy that so why do you do this? Why do I do this rather than just be a passive investor? I don't know.
It's fun.
It gives me something to do. It's my job, right? It's my job. It's how I earn a living. We do have passive investments, personally passive investments in equities, but it's the question is on the buy side. When you're on the buy side, where does this fit in? Where does it fit in with your portfolio? Does it fit in with your portfolio? If you're international fixed income manager, it fits in your portfolio. If you're a pod shop, it fits in your portfolio because you want uncorrelated strategies. And the strategy doesn't have any correlation to index, to bonds, doesn't have any correlation to indices. It has no correlation to foreign exchange because foreign exchange is a weird, at least for foreign exchange side, I should say. The foreign exchange side is a very sort of its own thing. And it has to do with, it's roughly related to differences in bond yields and macroeconomics, but it's certainly not terribly correlated to global all global interest rates moving one way or the other.
Yeah.
So yeah.
So then if you're sort of generally trading a like a long vol strategy rather than, you know, the sort of most other people, well, shouldn't say most other people, but a lot of other people that are, you know, sort of just generally short vol and trying to avoid the blow up.
That's
Does
really
that
hard to
mean,
do. So
yeah, does that mean that you like, do you always have a position? Like, do you have multiple positions on, or do you have periods where you've got nothing on and you're just waiting for a setup, if that makes sense?
I always have something on, okay, because I have a book,
Yep.
but my book can be very flat or very not flat. And at certain times of the year, I'll be very flat. And like right now in Eurodollar, I've been flat Eurodollar Vega for 2 years.
Okay.
There's nothing in it to do. But, you know, dollar yen's been quite a different story.
Yep.
Dollar yen the last 2 years has been fabulous vehicle for trading volatility, both long and short. It goes up and down. And, you know, um, there's a lot of reasons for that, but mainly for the options point of view, dollar yen. I mean, I've been trading dollar yen for over 30 years. And so for me, it's one of the, I guess it's like an analyst. If you've been an analyst, you've been covering 5 stocks or a sector for your entire career, you know a lot about it. There's certain things that go on in the dollar yen FX market and in the volatility, dollar yen FX volatility market that produce kinds of moves that you can prepare for. And
Okay.
it's because of dealer positioning. It's because of what the players are, what kind of products they like to trade. There's a lot of issuers and insurance companies. You know, I like trading sterling as well. Sterling is very good. It's sort of like euro dollar a lot of the time, but it's a lot more volatile. It can be a lot more volatile, a lot more unpredictable. And because it's thinner, excuse me.
Yeah.
Yep. No, no, not time. That's the risk manager coming in to say hello. No, I'm not over. And the S&P stuff is S&P trading S&P volatility. I share this opinion with a lot of people, I think, is that it's not much different from trading FX. It's pretty similar. It's a lot. Index vol, US index vol has a lot of similar products, has a lot of similar characteristics, has some dissimilarities to it, but it's certainly the skill set's very transferable.
Okay.
So if you're an FX trader and you're bored and you want to look at S&P, I encourage you, and vice versa, I encourage you to try. It's not like trading, swaptions. It's not like trading commodities. Commodities is tough, right? You've got all these different contracts and you've got a physical and there's delivery issues and they're not fungible. And the whole bond thing is, I don't understand it. It's too difficult for me. I cannot comprehend this swaption surface. It's just too weird.
Yeah.
So, um, yeah, but that's kind of where I am in the world.
So it kind of feels like, oh, I get the sense that, I mean, obviously you know, you've got some, um, like good quantitative training and you've been
Yeah.
around, but I feel like the stuff that you're doing in some sense is a lot more intuitive than sort of straight out of the book type stuff. Is that fair? Like you sort of need to
Mm,
have been around to have kind of experienced things to understand what you're doing.
Look, I think that's fair. Now, if you want to, there are strategies that I've seen in FX that we've traded against over the years as a market maker. You know, um, there will be institutions that'll run a highly quantitative portfolio analysis, and they'll say, okay, every day I'm going to sell 2 week. This is a real example. Every day I'm going to sell 2 week 10 delta strangles across 60 different currency pairs and sort of the same dollar notional amount. And the strategy backtests really well. Okay, great. So they do it. I guess one of the wonderful things about trading with other people's money is that if you do this for 3 years in a row, your backtest works, you get paid.
Yeah.
And the reality is, every time I've seen one of these strategies, it's ended up with catastrophic results. In 2007, 2008, the strategies lost hundreds and hundreds of millions of dollars. They lost more money than they ever made in the space of several weeks. I've been on the other side of that a lot over the last 30 years. And I've probably been on the right side of every major blow up. Or been at least neutral to them sometimes,
Okay.
or never lost a lot of money on them. So there are people now, they like to sell variance swaps. Well, if you like to sell variance swaps, you get to sell, volatility risk premium. You sell the volatility of volatility risk premium. You sell the smile, which is the smile premium. It's all in one. It's all rolled up. If at the money, if at the money S&P variance is 100, this thing's trading at 110 or whatever, you pick up more money on it, right? Because it's a swap, and then it realizes. But I'm very uncomfortable with that. I think there's if you trust your process that much, that's great, But I do think that if you specialize enough, there's this idea that your intuition or whatever is something that you learn over many years, and you're following rules even though you know what those rules are. So they're sort of heuristics, and you learn a very particular set of heuristics about how these things work, and if you can apply them well with good risk management skills, because you're not going to be right all the time, you're going to be right a little more than most of the time I'm right, but it's a question of how much money you're going to make, or sometimes you screw it up and lose a little bit of money. But it's not a purely quantitative process. To me, here's the issue I have with backtesting, the issue I have with machine learning generally is I haven't seen any results of machine learning that are any different than using a moving average. To be honest with you, there's no substantial return difference. So, I'm going to argue that that's the case. So show me something so much better, so better results given so much more intellectual input for that. It's very marginal. And then there's quant shops, and quant shops, if you find something, there's exceptions. I can't believe that XTX does as well as they do in G10 foreign exchange. Frankly, I never knew there was so much money you could still make in cash foreign exchange. But I find that like the eighth wonder of the world. Okay. I don't know how they do it, but it's fair. It's pretty exceptional. I have worked at some of the biggest banks. They found some relationships that work for them. I'm very impressed. But most of the quant stuff is pretty much people consistently, they might have a very small edge for a very short period of time. And I think they're all working independently to reinvent the wheel. And then the market adjusts to it, and this anomaly disappears. But I feel like the trades I get to do are repeatable because there's a certain number of players that keep doing the same kinds of trades. And the opportunity comes from the idea that you don't have there's the user base in derivatives, and especially in options, isn't homogenous. There are all sorts of users. You have pure quant traders, you have dealers, that are servicing the traders. You have macro guys that are they have a view, and they want to budget. They say, okay, I have $1 billion to trade. I want to put 2% into this trade. So for this 2%, I want as big a bang as I can get. I want the best leverage that you can show me for that premium, right? So they're going to go, it was my job to figure out what to show those guys so they could put their money to work. Well, that creates an opportunity for the person in the market where the dealer unloads that risk on. There's insurance companies that need, Japanese insurance companies, for example. It's one of the consistent opportunities in dollar yen is that there's so many Japanese insurance companies that do the same thing because they need the same yield. They have liabilities, and they have assets, right? And they need these products that dealers offer to give them consistent, like, coupons every quarter or whatever. So that creates opportunities.
Yeah. Okay. Interesting. So then this might not be an entirely relevant question because
Mm,
obviously volatility of NFX is very different to index volatility and that sort of thing. But you see, and probably like VIX is a really good example because it just gets talked about all the time.
mm.
VIX is quite low at the moment, and you sort of see on Twitter and various other places people sort of raising alarm bells that volatility is very low and something's around the corner and all that sort of thing. Do you have any kind of general thoughts around like the volatility market? And there's a lot of talk about that there's so many people selling vol that the market's structure's broken and that sort of thing. Do you have any kind of general thoughts around where the market is at in terms of is there something that's unfairly influencing the price of vol?
That's a good question. From what I see is, one of the persistent opportunities in S&Ps, I think, is that there are a lot of vol sellers and there are a lot of retail vol sellers. And there are these products that are constructed so that they can sell vol easily. So yeah, there is obviously the desks that offer these products, they know their value and they know they're making good money being short to these clients. And the question is when is this going to happen? When is it going to end? I don't know. I mean, how long is a ball of string? It's hard to say what the capacity of the market is. It's always changing. It depends on a lot of different things. I mean, the capacity of the market for volatility strategies is substantially lower than it was before 2014. In 2014, our regulatory geniuses introduced, Dodd-Frank and the Volcker rule. And Dodd-Frank and the Volcker rule, in my opinion, might provide more immediate protections to a particular investor, okay, or a class of investors. But what's happened to the market since then, I believe, is that there's just substantially more systemic risk for holes to be created in market liquidity,
Okay.
where you see there's very small inventory pools compared to what we used to have in, say, investment banks, and say that in treasuries, even 10-year treasuries, the way they move, people are concerned about that. Well, you should be, because when markets move, you shouldn't be 100 basis points movement in a 10-year treasury is I don't know when we had that last time, but that's something you should never see. That's a problem for what's considered the most liquid investment in the world. But the problem is that we see flash crashes where there's no liquidity, right? Because everybody's algo is just steps back and says, nope, I don't want those. I'm nope, no, thanks. Where there used to be somebody on a desk and said, I'll take a couple thousand of those, and then here I'll take a couple thousand more because that's what we do for a living. It's my job to do that, and and it makes a difference. And there are all these prop desks. It's gone, and to me, prop desk trading at the U.S. banks has never been has been a real source of losses. The most substantial losses are just bad mortgages, lending money to people who can't pay you back. It's a credit event. It's not market risk. It's credit risk. So that's been a big problem, in my opinion. And I don't think that the buy side community has stepped in to fill that hole. I mean, it's not their job, I think that that I see in the stuff that I'm in. I mean, you see it in the S&Ps. I mean, I think you see more volatility than you used to on a given day because people back away. The algos back away. You see it, and I've actually never used to see that. This is a caveat. When I say never or always or whatever, I speak very broadly. So, dollar yen, for example, if you watch the dollar yen price action, there were times when there's no price and prices will be a half a tick wide all day. And you can transact $100 million half a tick wide. And then suddenly there'll be 40 points wide. And you can't sell $1 million to save your life. And sometimes you won't even get the bid done or the offer done.
Yeah, right.
That's scary. That's not the way it's supposed to work. And that's because of the way algos work.
Yeah.
And the fear, the mass panic isn't panic, it's just the way they're built. I remember when, I remember, look, I don't know where algos are right now, but I was involved at a very big institution in 2015 and had a really good look inside our spot business, our spot trading business. And it was a very good spot trading business, and it was very well managed. And, I can say in 2015, when the S&P let the peg go, the Swiss floor goes out of chaos. I mean, a couple desks lost $400 million. I mean, $400 million is a lot of money. For a large global institution to lose $400 million, it's nothing, right? As JP Morgan said, when the London Whale lost $6 billion, that's not even a quarter, it wasn't even a quarter of the revenues, and it's far less now. It was a tempest in the teapot, but he made a lot of enemies by saying that in the regulatory community.
Yeah.
But our algos worked really well, and they captured a lot of the dislocations. But the problem came after, when clients start suing you because they say, well, those are market prices that there were market prices. There's no market. It was chaotic. You should give us our money back.
Yeah.
And that's something for the lawyers to figure out. But, part of the problem is that regulatory problem with these liquidity holes is also in the model that regulators understand is a centralized central order book model. And these markets, the treasury market, FX market, a lot of markets are not. They're bilateral markets. And prices can trade different things, and it's arbitrage that keeps them in line. So it's hard to say, what the fair price was at that particular instant. And the regulation, the global regulators, by, limiting these sorts of, I think it's, I guess in some sense, well, I'll leave it to the lawyers to determine whether it was effective or not. But my limited opinion, for my 2 cents personally, I think it's not great. Okay.
Fair enough. So I feel like, Sal, I feel like you've got some good stories from your years.
I guess.
Yeah. So maybe if you could give us like whether it's yours or just something that you've seen, or on the floor or on a desk or whatever, like the best trades you've had, the worst trades you've had or you've been involved in or you've seen, and I guess what the takeaway is from those.
Yeah. The worst trades I've ever had are ones where you're caught, you're caught short on big moves. You're caught short gamma on big moves. You're short big on big moves. And, it's oftentimes after, there'll be a confluence of events where you can't, as a market maker, you have to provide liquidity. And, interbank liquidity is poor right now. It used to be a lot better. And banks, guys like me used to make prices for guys at other banks. And we used to have something of a feeling of community. Like, if you make me prices, I'll make you them. And, I had relationships with about a dozen banks, which were essentially guys, individuals.
Yep.
That if I needed to do something, I could call them and get it done. And they would do the same for me. And it was just not a handshake that we would do that for one another. It doesn't exist anymore. So when you see, I remember getting caught up in something a dozen years ago in one currency pair where there was an enormous, it came from a merger and acquisition. And sometimes mergers and acquisitions, these tickets are really big. And they're in currencies where you don't see, dollar yen, euro dollar, the big equity indices. It's quite different than something like Australian dollar. Something like British pound, Australian dollar. I mean, a 6 or 7, a big like an M&A deal, international M&A deal, that's 60 billion sterling is going to move the market a lot. And and then you provide liquidity, you're short, which is your job, provide liquidity, and then some weird political event takes place, or some there's some election or something like that. And I remember, being on both sides of that. I remember I was in London in, I think it was just before Christmas, 1996, when we were sort of trying to wrap the book up so we could go out. And then Greenspan made his famous comments about, that was the deck. So we had gone out to dinner, and I had gotten food poisoning. The food in London is great. So I got food poisoning, and the next morning I'm feeling very ill, and then it was late in the day. I can't remember the exact timing, but Greenspan gave his favorite speech about irrational exuberance, and all hell broke loose. And I was so nauseous, and it was just a nightmare. I mean, the P&L was actually pretty good, but it was just so unpleasant. And but just what people think this is, there's a lot of excitement, but there's a lot of freaking terror too, right? Because the GFC was exhausting. It's exhausting every day to come in and face that, and you're extremely busy, and it's a tough job. I would say, anybody who thinks there's glories in being a trader at a desk, well, it's a different skill set than it used to be. It's very process driven now. It's much less judgment driven, because first of all, that's the kind of, I think, for example, it's more process driven now than it was. And that before it was judgment driven, you were much more autonomous because you had to be.
Yeah.
Generally, the management would cut you a lot of slack because they had to. They had no choice. There was a business they're in, and that's what they needed to do if they wanted to be in that business. Now it's different, So you're not gonna. But I mean, if you want to trade options, you really got to grind. It's a grind, and you got to like the grind, because I grind, right? And it's from Sunday night, it's from Sunday afternoon till Friday afternoon, and I do sleep, but you get woken up a lot, and maybe S&Ps is more fun, but it's not. It's a grind still, So I try to focus my time between very early New York till the early afternoon, and then I'll look at stuff around now, and then I go to bed around 10 o'clock and wake up at 4 o'clock in the morning. But stories. Oh, I was trying to remember a particularly funny story, and I guess when you get put on the spot, you can't remember them. But there was one. I don't know. There's just sort of very like trader humor, something to be wild. I don't know. I mean, I just remember the attitude, I mean, the fun thing about the floor and the terrifying thing about the old floor at the same time, the exchanges, was that you show up there and you have to learn how to be able to deal with everybody, right? And I was a pretty introverted kid. I was very scholarly, sort of, pretty nerdly. And you show up there at the floor, and you've got guys that used to drive beer trucks that after they were done with driving beer trucks, you have PhDs, you have criminals, people will talk about it, but there's a fairly seedy underbelly. There was a fairly seedy underbelly to some of these places. But there's all kinds of people with all sorts of motivations, and you can't go to HR because there's no HR. They don't work for you. You don't work for them. And you have to figure out a way to get along, because that's your job. And that was really valuable. It was a really valuable thing. And, people would let off steam like, used to make paper mache appendages and tape them to people. I don't know if you heard these stories.
No.
There was one where the famous one is, it's on, if you Google who put a dick on my back. It's quite funny. I'm sorry, you're gonna have to cut this, maybe. I don't know. But
no, I won't cut it. I'll play it for sure.
It's hilarious. And you can Google it. If you Google it on YouTube, it's one of the scenes. But they used to be spurs. People will come on the floor. Somehow they'd sneak out and put these big paper spurs, And then people would gather around him and start going cowboy stuff like yeehaw, yeehaw, woo. And they look at you like, what is going on? And then they noticed they had spurs on their heels. That was the gag. And then, you know, in the 90s, there was big hair, you know, like really tall hair. So they had the hairometer, you know, it's the guys who had the hairometer. And it was like a record of who had the highest hair. You know, it was this big cardboard like thing. They come out and measure the people's hair, and whoever had the highest hair, you know, it was, and that's what people used to do, you know, because we'd act like 12-year-olds when we were bored, you know,
Yeah.
and I remember the Philex I mean, you see like one night, somebody dragged a couch onto the floor. They found it out on the curb. You know, I dragged it like a block and put it on the floor for the exchange. People were sitting on it. It's like, oh, you know, but generally it was,
Sounds fun.
it was a lot of fun. It was a lot of fun. It was a great learning experience. Um, you know, um, you know, I have to say, my best teacher in my career was a woman named Susie Shannon. And Susie is about, I don't know, 5'1" or 5'2".
Okay.
And she was probably the best market maker on the floor. And
Okay.
she was really good. And I learned a lot from her. I really liked her. You could hear her voice. It didn't matter how little she was. You could hear her voice like a block away, right? And and she was pretty fearless, very, very good trader. And you know, and I think one of the reasons why the women that I knew were so good was because they had to be,
Mm.
you know, because guys were awful. You know, we were awful to everybody, but you know, everybody could be awful to everybody else. You know, one day a guy comes in, he's got a really huge pimple on his nose. Oh no, it's on his forehead, like right here. Okay. So this thing, people are giving him shit about this pimple all day. So he goes out to lunch. So when he goes out to lunch, one of the clerks goes to the stationery store and buys like those stick-on red dots, right? So it comes in, everybody had a stick-on red dot, like right here on their the same spot where he had his pimple. So and there's like 400 people with red dots like that on their face. That was funny. So that's one of the highlights of my career.
Yeah. Cool.
Right.
So is there any advice that you'd give anyone that's sort of just starting out that sort of wants to get involved into FX or trading volatility on
Or
FX?
just, you know, trade, let's say options trading in general, right? Because it's
Yeah.
kind of like a lot of it, you know. I mean, and what's available to the what's available to, I'm not sure, you know. I mean, there's younger people, there's more people that are more keyed in on the institutional desk side that go to the bank every day, go to the fund every day. You know, I'm in my own space with a few people I interact with, but I'm not sure how someone comes out of, say, university and ends up um, being really fluid in the knowledge they need to. I mean, they do, but I don't know exactly how that path works anymore. The path I was always very clear, you know, and market was an upswing, activity was an upswing, research was an upswing during those years. You know, I mean, fundamentally, there hasn't been in derivatives pricing. I don't think there's been a real breakthrough in over a decade. You know, so you know, 2006, 2007. I mean, you can invent financial products now. The question is that no one is allowed to actually to trade them. Okay, so you can come up
Mm.
with the most innovative thing in the world, but from a risk perspective or from just a legal perspective, the inception of creating the product, talking to the client, finding out what their needs are, engineering the product, safety testing the product, getting the sign off, it takes much, much longer than it used to. There's many more hands involved, and it might not even happen. So, you know, I think it's challenging. But for someone who's trading on their own, someone who's an amateur investor, the only thing I can say is I knew a lot of punters that, you know, the guys used to come over from the spot desk and say, oh, dollar yen's going to 150. And it was 145. I need a $150 call, and you'd sell it to them. Hey, don't you want a 147? No, mate. It's going to go there. I know it's going to go there. And so they would buy a 1 month 150, and it would go there, but it would take 5 weeks to go there, or it would go to 150 and then sit there, and they wouldn't sell it. So and this happens over and over and over again. Your underlying market view might be right, but it makes a lot of sense to think about how you structure that and be very careful about it, because that's why I don't get these zero DT options. They don't appeal to me. The only thing I ever do with them is sell them. I don't buy them because I sell them. I can lay them off against something else. But if I buy them, what are you going to do with them? You know, so you're in for it all day if you buy them, and retail buy them, right? So, you know, if believe me, Citadel is not long a lot of us, you know.
Yeah.
So I would say if you're trading options and it's really appealing to look at the leverage of what could be, you know, and say, oh, wow, I can buy so much notional of this 2-week $10 to option. How about buying 30% of that notional and making it a longer date and putting the strike a little bit closer to where the market is? Because I think you're going to have a lot better chance of actually going there, making money on it.
Yeah.
And also, if you're wrong, there'll be something left that you can sell.
Yeah.
And that's my, from people who trade options directly who like a punt, that was the only sort of my personal advice. That's the only thing I would give.
Yeah, that's good advice, actually. I've been on the wrong side of that advice a couple of times myself.
I think we all have. That's how we learn, right?
Yeah. You sort of get a bit carried away, and then it's almost there, but then it's gone.
Yeah, remember the old we don't have them, but do you have CFDs in
Yeah, we
Australia?
do. Yeah.
Yeah, those old binary options.
Yeah.
Yeah, we don't they don't they're not allowed to be done here, but you know,
Yeah, we're just like a country of gamblers, so we sort of have
criminals.
pretty much, criminal gamblers. So
That's all right.
yeah,
That's good. That's good.
it's
Yeah.
good fun. So
Uh,
look, Sal, thanks so much for coming on the
oh, thank
show.
you. This is my first podcast, and I've never done this before. So,
No, you did really well, and I feel like I
I
could
hope
talk to
so.
you. I feel like I could talk to you all day about all manner
Oh,
of
thanks.
things. So look,
All
thank
right.
you very much. I appreciate
Oh,
it
thank
very
you.
much. Thanks everyone for watching. Once again, please like and subscribe to the show if you can. Your support is appreciated, and we'll catch you next time. Thanks so much. Bye.